Andrew Chapman-Coombs, and today we're going to be talking about whether you should buy your own property or continue to rent. We're going to be looking at some of the figures involved and whether or not you should be looking at your own property as an investment and whether or not renting is the right thing for you to do. So over a period of time we'll know that when you're paying rent to someone you're not actually accruing any interest in that property. This is money that's going to someone else's pocket in order to provide a roof over your head. So I'm just going to draw a quick chart on the board here, and we're looking at a period of time and dollar values. So we know that from the very moment that you pay your first rent payment, you're paying that money out over a period of time. And the more money that you pay out, the more money is actually going into someone else's pocket. Now that money could be going towards your own property and could be going to investing in your own property. But there are some pitfalls that you need to be aware of, and it may be interesting to find out at what point do you start to appreciate value after the initial expenditure of purchasing the house. So I'm just going to amend our chart slightly. I'm going to put a zero line halfway along it. Okay, this will make sense in just a second. $0. And let's assume, for example, we're going to purchase a property that is $172,000. Okay, we're going to look for a 10% down payment, which is $17,200, and we're going to make our down payment, and it's going to be just down here. Now I'm going to put minus 17,200. It's a negative value because this is money that we're paying out, so we're actually having to take this from other sources, whether it's gifted money, whether it's money from family and friends, whether it's our savings. This forms our down payment, and it's something that we have to pay out before we can start to appreciate any value in the property. From the very moment you purchase the property, you're making payments on your mortgage, so you're therefore putting money back into your property. So similar to your rent line here, we've got a line that kind of goes up and across, and this is your mortgage payments going forward. Obviously, over a period of time, you're trying to recuperate the money that you've already spent in your down payment and closing costs. Now that's going to be sort of a negative equity situation. This is where you're trying to get back to that zero line, ready to start appreciating value in your property. Anything past that point, anything on this side of the zero line, this is money that you're appreciating into your property. So you're paying down that mortgage loan, you're adding value back to the asset that you've just purchased. Now it may be interesting for you to know that to reach this point just here, on 172,000, and with the assumption that your property is going to increase in value by 2% per annum, so year on year, that's a pretty conservative figure as well for house property. To reach this point where you cross from trying to make your money back to actually investing and paying down the loan and making money into your property, is actually only 3 years. So if you're a short-term renter, you're someone that's moving from place to place or job to job, and you only need a 6-month or a 12-month lease to move for work, then maybe renting is the right thing to do because you're never going to quite reach this 3-year point. However, if you're looking for long-term rent opportunities, or you're a long-term renter and you've been in rented accommodation for a period of time, it's easy to see that after 3 years you're starting to pay into the property that you have. So once you reach this point and you go to put it on the market, the chances are if the market has been increasing, you're actually going to make back the money that you've spent and you're going to make a pretty nice profit on it. So this 3-year point can actually be moved further across as well by any investment you do into the property. So say for example you change the flooring and put hardwood flooring in, you might update the kitchen or a bathroom perhaps, or landscape the yard. These are things that would actually bring the value of the property higher and move your 3-year mark further back. Likewise, should the actual value of the properties in that area in your market increase more than 2% on a year, then obviously this 3-year term moves further back as well. Okay, so that gives you a bit of an idea of how you can invest in your own property and over what period of time it takes before you actually see some money appreciating into the property itself. I'm Andrew Chapman-Coombs, and you've been watching me on my video blog. If you've got any questions or any comments on what you've seen today, please email me at andrew@chapmancoombs.com or visit the website chapmancoombs.com for more information. Thanks for watching.